Joining us right now with some of their stock picks are Kevin Simpson. He's the founder and chief investment officer of Capital Wealth Planning. Also, Andrew Graham, who is the CEO of Jackson Square Capital. And gentlemen, just starting off with this, as we're getting ready, getting back to school, what message, Kevin, would you be giving investors as they get ready to come right back to business?
Well, summer's over, Becky. It's time to get back to school, back to work, back to reality. No. Time for a new wardrobe, new backpack, fresh supplies. We can't wear what we wore last year. And Becky, we can't invest the way we invested last year. Let's be honest, for the past 10 years or so, dividend-paying stocks may not have been the most exciting place to invest, but they certainly have performed well. And I would say that sometimes boring can be quite good. Last year, you could invest in companies that increased sales, top-line revenues. It was fun, exciting. Think meme stocks. Companies didn't even actually have to make money, yet their prices would go up even as their debt piled up as well. So I think this year, back to business means back to earnings, and earnings are going to matter.
We're going to talk about what you think is the most boring, and by boring, we mean good, in just a moment. But, Andrew, let's just get your overall thoughts. We did see prices come down pretty significantly in the market if you're just looking from January at this point. Was that enough, that de-risking enough? And where do you think we're headed once people get really back to business?
Yeah, I'm not sure we can say for sure. I think the back to business is more like back to healthy volumes, too, for the market. And this is always a really challenging period. This last 2 weeks of August, you've got a lot of high single stock volatility. You saw it in a couple of names recently, MongoDB and whatever, another earnings announcement here and there. But you got to collect all that information. And I think when we get back next week, or actually the following, you're going to have the advantage of a lot of sell-side analyst conference, companies being able to talk and give a little bit more color on the picture going forward. That's going to help bring some more clarity. But generally speaking, yeah, the market's down a lot. I treat this more like, when are we going to get to the clearing event or the de-risking event? And I think a lot of the earnings revisions that have been going on here really since May, and especially after Q2 earnings seasons, which is kind of still just trickling through. Once that's done, you kind of have this de-risking of markets, because that'll be for the 2023 calendar estimates. And so I look for that to be an opportunity, I suppose, to see if the market can put in a floor. And I suspect that it will, but we want to see more evidence.
Very quickly, you don't think June 16th was the bottom then?
No, I like that number, that 3660 number for the S&P. That's fine. I actually think it's going to hold 3,900 or 3898 or whatever it is, which is, there's some witchcraft or voodoo in there. But yeah, you need to see more. We've been playing defense since really about mid-January with client portfolios and having lots of cash and all the rest of it. And I'm, ready to get back to work. And what we're trying to do is use this period to collect the strong stocks, the ones that act the best in this horrible tape, and the ones that are putting up big quarters. And so we've got all that information. We're anxious to see what they look like once the market does actually make a bottom.
Let's run through some of those names very quickly from each of you. Kevin, first up, you like boring, you like Chevron. Is Chevron the boringest of the boring for you?
Well, I also like a little voodoo and witchcraft, who doesn't, Becky? But I like to keep it simple, companies that make money, companies that increase earnings, and most importantly for us, companies that increase dividends. So we're looking at a stock that's paying about a 3.5% yield right now. But more importantly, for the past 5 years, it's given us a raise of about 4%. And I don't know exactly where inflation is going to end up, but at least if we've got a company increasing that cash flow by 4% a year, that's a true hedge against inflation, and it makes me feel very comfortable.
Andrew, your favorite name?
I think right here, probably AbbVie, talking about dividends. Kevin, there's a 4% dividend yield on AbbVie. It's a pharmaceutical company, of course. There's sort of a little controversy around the stock, and that's got this, it's trading down at 12 times trough earnings, which is the lowest we've seen in more than 2 decades. It's lower than where Pfizer was 2 decades ago when it had nothing in the pipeline. AbbVie's got a lot in the pipeline, including 2 replacements for Humira, which is the reason for the controversy. The company's going to announce earnings at the end of October. I expect them to give us an update on what the glide path is going to be to post-Humira earnings. Once that happens, that's the de-risking event. You want to be invested before that happens. And we just think it's an easy stock to own here with Rinvoq and Skyrizi coming in, and those launches going much better than expected.
Andrew, Kevin, thank you both. Have a great weekend, guys.